Now to our first conversation. The Lagos Shortlet market has been generally on an uptrend due to accelerated demand against the backdrop of the pandemic. But now let's take a look at how the market is looking with rising inflation, increasing diesel prices. Joining us now is Dolapo Omidire, CEO Estate Intel. Join us right there. Great to have you on the program. Omidire, CEO Estate Intel. Good morning. So how's the long and short stay market looking at this time with all of these headwinds?
What we've seen based on analysis is that over the past 3 years, the shortlet market has grown by about 263%. And that's really in the total amount of listings and rentals that people are putting onto the market. Right now, there's a lot of pressure because operational costs are rising, inflation is going up, diesel is going up. And as you know, with Shortlet, it's an all-in price for occupancy. So there's no extra fee that you're going to be collecting. So what that means is that people are having to increase their prices. They're trying to increase their prices to accommodate for this change in the market situation at the moment.
And looking at the market right now, where do you see interest? When we're looking at areas to situate most of these shortlet investments.
I think there is coverage across the city, but based on the research that we've done, we see about north of 6,500 active rentals, and most of them are focused within Ikoyi, Lekki Phase 1, Ikeja, and Victoria Island. So that's where we see a bulk of the stock. Now, the performance can vary across the locations. Even outside those regions, you still have high-performing shortlets. But in terms of the size of each individual market, those are the top 4 that we're seeing the most.
And why are other areas not getting, this kind of attention, we're seeing with Lekki?
It's about the amenities. So if I'm going to a short stay apartment, I'm looking for convenience, I'm looking for access to either business hubs where I can go to work or access to leisure and other amenities. So if I want to go out to work, via Ikoyi, Lekki Phase 1, an ideal place to do that. There are lots of restaurants, there are lots of bars, other commercial things like banks, etc. They're all very clustered and concentrated in these areas. And for Ikeja as well, on the mainland, that's where you also have a similar cluster. So that's where you find most of the activity. I still think, or this doesn't mean rather that there isn't activity elsewhere. Ikati has quite a lot of units as well, and even going down the Lekki corridor and other regions. But in terms of the largest amount, I think the access to amenities and proximity to where all the action is why those regions are right at the top of the list.
All right, let's look at long stay and short stay now. Which one is getting more attention in your opinion?
It's hard to say, but I mean, I think it's a bit of a balance. Now, if we look at the drivers of this market, we have people coming from the diaspora. There is the professional expat market, and then what I can call young and liquid professionals, and people just looking for a staycation. So it's a balance. Most of those are actually more short stay type. Which I would say is ranging anywhere between 50 to 30 days. But you do have longer stay demand for more of the business professionals that are here for 3-6 months and probably don't want to stay in a hotel, but they're not here long enough to rent an apartment for a year.
And what would you say, are the key, drivers, for this short stay market?
Yeah, it's just like I mentioned, the diaspora and the young liquid professionals, we can term them, also business professionals. And one thing that we noticed post-pandemic or during the pandemic rather, was that once a lot of the hotels closed up, it redirected quite a lot of demand to the short stay market, which of course wouldn't involve you going into a 150 room facility, most of which were closed anyway. So I think that's what we're seeing driving the market. And to some degree, it can be seasonal. With the diaspora market, you see that, of course, it's going to be during wedding season, December, sometimes during summer, that the volumes significantly increase. But other parts of the year, it's not completely down because the other segments that I mentioned still keep occupancy up to a degree.
And, some investors looking to, come into this market now, what do you think they should be looking at, before diving in? Because obviously it's not that straightforward.
I completely agree. And I think to some degree, or rather, quite a lot of people think that it's just really about renting an apartment and furnishing it and just listing your Airbnb. To really be successful with short stays, what you want to do to ensure that you can guarantee that occupancy is one, have staying power. And also be able to pay attention to the finer details for the operational aspect of the facility. If you want that occupancy, you're going to need to invest in the right type of furnishing, the right type of fit out, and the right type of management quality. So even if you don't have a facility manager, the process around ensuring that things are clean, things are well maintained, things can be repaired if they're fixed, that's really what will differentiate a non-performing shortlet alongside with another. This is in isolation of all the other basic things like, is it in a good location, is the property decent? But that operational aspect is very important, and I think it's one that sometimes new investors underestimate.
And can you paint a picture of what the value chain of this market actually looks like?
When you say value chain, what do you mean?
Like from, an investor perspective, now you're investing in, you see this property, you say, okay, I want to invest in this one. What else, what other industries benefit, from this sector?
Oh, sure. I think the service industry, when it comes to support, like support staff. So if people are just renting regular houses, it was probably most likely might be maintained internally. But by the time you are listing an apartment and you're putting it on the market for shortlet, most likely you're going to create a small operation to ensure that it's managed. So in terms of, say, additional people employed, we're looking at real estate professionals sometimes, a few more cleaners and people that are going to be doing the management of the facility. I think that's probably the first layer, the primary people we can say that are impacted. Outside that as well, I think the more people pay attention to that design and that finishing, interior decorators are also probably enjoying themselves now doing fitting out and furnishing shortlet apartments for their respective investors and clients.
Yeah, quite interesting, because I've seen some really nice designs on social media, and they look quite good. But how is it inflation and rising cost of diesel? How is it impacting that market really?
Yeah, I mean, I mentioned in the beginning with short stay, you are paying a flat rate per day. Negotiated, you can do a weekly or a monthly rate, but the headline cost is usually a daily rate. And this rate it has to account for everything: the services, the power, the whatever. It's all in. So what that just means is that if I'm guaranteeing you 24-hour power in your shortlet unit and you're still paying the same rate that you were paying when diesel was 300, or you're still paying the same rate when inflation was a completely different figure, that means I'm going to be suffering and it's going to be eating into my return. Now, shortlet returns are quite attractive, and I guess there is some room for that to be reduced for at least those who are seeing good occupancy. But what I expect to see is that people start to increase their daily rates to accommodate, or not start to, they are increasing their daily rates to accommodate for the similar price changes, or they start to look at alternative ways to structure the occupancy. Maybe power is not going to be 24 hours in all the shortlet units, but that's how people are trying to account for that change.
Right. And if I'm a first-time investor looking to, dive into that market, what should I be looking at?
You know what I'll say, if you're a first-time investor, I would be very cautious. Of course, it's a difficult period now, but I think in the next 2 to 3 years, or it's not even that far out, let's say 1 to 2 years, we have quite a lot of institutional demand from domestic investors and really big long-term players in the real estate industry. When people have seen how attractive the shortlet return has been over the past 2 to 3 years, and we're seeing purpose-built facilities under construction and are expected to be completed in the next 12 to 24 months. So as these facilities finish and they're purpose-built, apart hotel style, really well structured, in comparison to the ones that pretty much people are just doing, okay, I found this house, I'm going to cut it up into units, I'm going to rent it. That purpose-built stock is most likely going to perform much better, and it might be well managed, and it will be able to mop up demand from all the regular type rentals. So people who are trying to enter need to make sure that their units can perform well in a high supply environment. I think the summary of what I'm trying to say is there's a lot of supply coming onto the market, and a lot of the supply is going to be high quality and purpose built. So if you're looking to develop or looking to enter this space or stay in the space, what you need to do is make sure that your unit can survive in a high supply environment. And what that just means is that you need to make sure it's well managed, well specified, and it's just good quality. It can't just be something that's passive. You really have to be intentional about ensuring that the unit that you're trying to get people to stay in is really good. And I think in that case, you'll be able to survive. But if it's not something you can do, then I would be extremely cautious and potentially just take a wait and see approach over the next 2 to 3 years.
And, and obviously, every investment, comes with, some risk. What are the risks in this market? What do they look like?
I mean, the clearest one is just occupancy, low occupancy. So if you finish your unit and you develop it and you put it onto the market, put it on Airbnb bookings, you tell a couple of agents, if you can't find tenants, that is the biggest risk. I mean, there are different ways. It's usually hard in the beginning, and you apply discounts just so that you can get some traction. But the biggest risk is not getting that occupancy. And the real thing to do to mitigate that is, one, speaking to investors, doing some research to understand, okay, in this area, what type of units it does well? Is it the 1 beds? Is it the 2 beds? Is it the 3 beds? Do I need to do a very extravagant furnishing? Or can I do something standard and clean and simple that will perform well? So it's that additional research that one can do that would really make it easy, or it will de-risk it to some degree. But I think the biggest thing, or the glaring risk, is just not being able to find occupiers for your property.
Quite interesting. But how is technology, playing into that market?
Well, we're seeing Airbnb, of course, is being used, bookings, but quite a lot of the transactions are still offline, with agents who manage properties and are still using word of mouth and network. But Airbnb and a bunch of the listing platforms and some of the, I can't remember the name right now, but some of the management platforms, just to ensure that all the bookings, the data from the occupiers that are staying is logged in properly. But yeah, that's how I'd say tech is playing a role in this.
And you're talking about listing platforms. Which ones are used the most here in Nigeria? Is it the international brands? Because you mentioned Airbnb there. Do we have homegrown platforms that are actually getting those sales out there?
There are a few of them, but I think, like I said, it's a mixed bag. Tech is playing a role with some of the local platforms and some of the global platforms like Airbnb, but it's still a good number of those transactions are still being concluded with agents who just manage or know of a bunch of units and can refer and close.
And it's the first half has been quite impressive, but what are you seeing, going forward for this market?
For the short stay market, I mean, it goes back to the outlook that I gave in terms of the incoming supply. Incoming supply is something that we've seen across a lot of markets. In the office markets back in say 2008 to 2014, it was fantastic. And quite a lot of investors saw that. And that led to a really big supply dump in 2015, 2016. And that has put pressure on the office market since then. We're seeing a similar thing happening in the short stay space. So I think it's really important that if you are looking to deliver, especially in large quantities, you need to make sure that you are staying abreast with what is going on and you are sure that your unit can survive.
Yeah, so much to unpack there, and investing in that market, obviously it comes with risk, but I guess the benefits the benefits are not so bad. All right, now let's look at more of the commercial spaces now. How have they performed this year?
It's an exciting one, and I think my opinion only recently just changed. Like I mentioned, the office market has been under pressure, and as the economy has contracted and has really not been in a good space, it just means that really big businesses as well who can take up office space are not going to be expanding. But I think this year has really been good in that a lot of the large spaces, and we're talking grade A, grade B office buildings in Victoria Island, Ikeja, or rather Victoria Island, Ikoyi, and the prime ones or the grade B plus ones in Ikeja are not doing badly. Post-COVID occupancy rates have definitely grown. And even though they're not saying 90, 100%, they're getting into the comfortable 70s and 80s, especially the really big buildings. So I think that's one positive that we can look at. On the other hand, I think the FX, which is FX situation and the devaluation, or not the devaluation of Naira, but the volatility of the Naira, especially on the black market rate, it really makes it difficult for anybody investing in large-scale real estate. So this is shopping malls, office buildings, hotels, because most of those properties are financed in US dollar. So any volatility there puts pressure on the tenants because the tenants are paying most likely dollar-linked rents or dollar rents. So it just puts pressure on them because a lot of the time they're not going to be able to get it at the NAFEX rate. So it also means that maybe some discounts are going to have to come into the picture, which obviously then put pressure on the owner who is paying back a bank, repaying their loan. So anything that has to do with FX volatility, it's not great news for anybody investing in real estate. But in terms of the performance of offices, I think it's starting to stabilize. But we'll see how it continues to progress based on the new supply that we're expecting in the next.
All right.
In the next.
All right, we'll keep tracking that market to see how it grows. Thank you so much, Dolapo Midire, CEO, Estate Intel. It was great having you on the program.
Okay, thank you.
Thank you. All right.